When the world broke in 2008, it wasn't just banks that collapsed. It was faith itself, faith in the invisible machinery that had promised prosperity without consequence. The crisis began with subprime mortgages, but beneath the headlines lay a deeper rot. Decades of leverage, speculation, and the collective belief that debt could grow faster than the real economy forever. As the system convulsed, central banks faced a choice between chaos and control. They chose control, or at least the illusion of it. Interest rates were cut to zero, and a phrase few outside of finance had ever heard entered the global lexicon: quantitative easing. In theory, it was elegant. The central bank would create money electronically, use it to buy bonds, and inject liquidity into frozen markets. The goal was to lower yields, push investors toward risk, and reflate asset prices. In practice, it was something far greater and far more dangerous. QE was a new social contract between markets and governments, one where prices no longer reflected risk but policy. Every crisis since then has been met not with reform but with rescue. The financial system learned that it would never be allowed to fail, and once that lesson was internalized, moral hazard became the foundation of the global economy. At first, the experiment worked spectacularly. Stock markets soared, real estate recovered, and investors hailed the Bernanke put as the triumph of modern monetary policy. But QE was not a medicine, it was morphine. It dulled the pain while leaving the disease untouched. Each round of asset purchases expanded balance sheets and pushed yields lower, forcing investors to chase returns wherever they could be found. Pension funds dove into junk bonds. Hedge funds levered up on derivatives. Retail traders discovered that buying the dip was not just a meme, it was a monetary doctrine. In just a few years, the cost of money became so low that risk itself seemed obsolete. The entire global economy began to reprice around a single assumption: that interest rates would never rise again. Governments borrowed as if debt had no gravity. Corporations issued bonds to buy back their own stock, creating the illusion of growth through financial engineering. Startups with no profits and crypto projects with no products soared on a wave of liquidity that blurred the line between innovation and delusion. Behind it all stood the central banks, their digital printing presses humming in synchronized rhythm. The Federal Reserve, the European Central Bank, the Bank of Japan, the People's Bank of China, each trapped in a race to the bottom, each terrified of what would happen if they stopped. Because QE was not just an emergency tool, it became the system itself. Every dollar, euro, and yen created through it inflated asset prices, widened inequality, and encouraged speculation, while the real economy, wages, productivity, savings, stagnated. The markets celebrated growth, but it was synthetic, born not of enterprise, but of stimulus. The wealthy, owning most of the assets, saw their fortunes multiply. The working class, priced out of housing and burdened by debt, watched the cost of living rise while their purchasing power eroded. The era of cheap money created prosperity without progress, a mirage that glittered brightest right before the desert of reality. By the mid-2010s, even policymakers knew they had gone too far. The Bank of Japan was buying not just bonds, but entire equity ETFs. The European Central Bank's balance sheet ballooned beyond 8 trillion euros. In the US, the Fed's balance sheet crossed $4 trillion, an unimaginable figure before the crisis. Economists called it unconventional monetary policy. Critics called it financial alchemy. Yet no one could stop, because the markets had become addicted to the drug. Every hint of tightening triggered panic. Every promise of stimulus ignited euphoria. QE had rewired investor psychology, replacing capitalism's discipline with a new religion: central bank omnipotence. Investors didn't just buy assets, they bought faith. The faith that the Fed would always step in, that the ECB would always print, that the Bank of Japan would never let yields rise. In that faith, risk died. And when risk dies, bubbles are born. But the trap wasn't just financial, it was political. The cheap money era allowed governments to delay hard choices. Deficits didn't matter when borrowing was free. Tax reform, productivity, structural change, all could be postponed because printing money solved the symptoms, not the causes. Politicians discovered that QE could finance not only bailouts, but entire fiscal agendas without raising taxes. Voters, too, embraced the illusion. They saw rising stock markets as proof of prosperity, even as real wages stagnated. QE blurred the line between monetary policy and politics until central bankers became unelected gods, worshipped when markets rose, cursed when they fell. By 2019, it was clear that the global economy had built itself on a paradox. The very policy meant to save capitalism had quietly replaced it with something else, a perpetual motion machine powered by debt, sustained by belief, and doomed by its own success. QE had worked too well. It had banished recessions, suppressed volatility, and created an illusion of stability so convincing that the world forgot what risk looked like. But underneath the calm surface, pressure was building. Every dollar printed inflated another bubble. In tech stocks, real estate, corporate credit. The world didn't notice because the surface was smooth, the markets were quiet, and volatility was low. But stability breeds fragility. When nothing is allowed to fail, everything becomes too big to fail. Then came 2020, the year that turned the experiment into an empire. When the pandemic struck, fear spread faster than the virus. Economies shut down, supply chains froze, and markets imploded. In a matter of weeks, decades of progress evaporated. But the central banks were ready, armed with the same playbook that had saved them before: print more, promise more, and hope the system could absorb it. This time, however, the scale was biblical. The Federal Reserve expanded its balance sheet by trillions in months, slashing rates back to zero, launching programs to buy not just government bonds, but corporate debt, ETFs, even junk bonds. The European Central Bank and Bank of England followed suit, while Japan, already years deep into its own monetary labyrinth, simply doubled down. The logic was simple but deadly. If QE could save markets in 2008, it could save entire economies in 2020. Money became infinite, and so did the faith that it could fix anything. Governments unleashed fiscal stimulus on a scale never seen outside of war. In the United States, Congress spent over $5 trillion in pandemic relief, financed by debt that was instantly absorbed by the Fed's printing press. Households received checks, businesses received loans, and investors received a message: risk no longer existed. The result was euphoria. In the middle of the worst economic collapse in modern history, stock markets hit all-time highs. Unemployment soared, yet asset prices exploded. Home values doubled, crypto went parabolic, and speculative mania infected every corner of the financial system. Money was no longer scarce. It was oxygen, freely available to anyone willing to breathe it in. But what no one saw, or refused to admit, was that this final injection of cheap liquidity crossed the line from rescue to recklessness. The system that had been built on easy money now required it to survive. Every dollar printed to prop up one part of the economy destabilized another. Supply chains broke, demand surged, and suddenly, for the first time in decades, inflation returned. At first, policymakers called it transitory, the natural byproduct of reopening after lockdowns. But as months passed, it became clear that something fundamental had shifted. Prices weren't just rising. They were accelerating, driven by the very forces that QE had unleashed: too much money chasing too few goods, too much demand chasing too little reality. The paradox was complete. For years, central banks had fought deflation, desperate to create inflation. Now they had it, and couldn't control it. The trap was sprung. To fight inflation, they had to raise rates, but raising rates would collapse the system that cheap money had built. Every government, corporation, and consumer in the developed world was now leveraged to the hilt, dependent on low borrowing costs. The Fed faced the most impossible equation in modern history: stop inflation and destroy the markets, or save the markets and destroy the currency. For decades, they had chosen the latter. But in 2022, the tide turned. Inflation hit 9% in the United States, the highest in 40 years. Energy prices spiked, food costs soared, and the political pressure became unbearable. The era of easy money ended not with policy, but with panic. The Fed raised rates at the fastest pace in generations, trying to unwind 15 years of excess in 15 months. But the damage was already done. Trillions of dollars in paper wealth evaporated. Tech valuations collapsed. Real estate stalled. Crypto imploded. The everything bubble began to deflate, not with a bang, but with a long, grinding hiss. Yet beneath the chaos, something deeper broke: trust. For 15 years, the world believed that central banks could bend reality, that they could print prosperity and erase risk. But inflation shattered that illusion. Suddenly, the institutions that had been worshipped as saviors were revealed as gamblers who had lost control of their own creation. The credibility of money itself came into question. If central banks could create trillions with a keystroke, what was the meaning of value? If governments could borrow endlessly without consequence, what was the meaning of discipline? The great illusion of the cheap money era, that debt didn't matter, that growth could be engineered, that cycles could be abolished, began to crumble. And as it did, the world rediscovered something it had forgotten: that there is no such thing as a free lunch, not even in economics. For the first time in a generation, the cost of capital mattered again. Investors who had grown up in a zero-rate world suddenly had to confront gravity. Corporations that once survived on refinancing faced insolvency. Governments that borrowed recklessly saw interest payments explode. The wealth effect, that invisible engine of consumption driven by inflated asset prices, went into reverse. People who once felt rich on paper felt poor in reality. And as money tightened, the cracks widened: in housing, in credit, in confidence. The end of cheap money was not just a financial event. It was a social reckoning. It exposed how deeply the global order had been built on illusion: that endless debt could sustain infinite growth, that printing could replace productivity, that policy could replace physics. By 2023, the global economy was living in the hangover of its greatest high. The binge of liquidity that had defined the 2010s and exploded during the pandemic had left behind not prosperity, but dependence. The world was addicted to cheap credit, and like any addict in withdrawal, the symptoms were painful. Growth slowed, markets convulsed, and confidence wavered. What had once been seen as strength, record-high asset prices, record-low interest rates, was now revealed as fragility. The foundation of the modern economy had been built not on productivity or innovation, but on leverage and belief. Every sector, from real estate to technology to government finance, had been engineered around the assumption that money would stay cheap forever. When that assumption died, so did the illusion of stability. Central banks, once revered as omnipotent, found themselves powerless in the face of their own creation. They had printed their way into a corner, raised rates too far, and they risked breaking the system. Cut them too soon, and inflation would return with vengeance. The choice was between recession and rebellion, between the pain of discipline and the chaos of denial. Markets no longer danced to the tune of earnings or fundamentals, but to the heartbeat of central bank meetings. Every word from a policymaker could trigger billions in trades. Investors hung on every sentence, not because they believed in growth, but because they feared the alternative. The economy had become a theater of psychology, a world where belief itself was the final asset. Yet outside the markets, reality told a different story. The cost of living crisis, born from years of suppressed inflation and reckless money creation, hit ordinary people hardest. Housing became unaffordable. Food and energy costs soared. Wages struggled to keep up. The same policies that inflated wealth for the few had impoverished the many. Inequality, once an abstract statistic, now had a face. The family priced out of their own neighborhood, the retiree watching savings erode, the young generation realizing they could never afford what their parents took for granted. The cheap money era had promised prosperity for all, but delivered it only to those closest to the source: the investors, the asset holders, the corporations that learned to play the system. Governments, trapped by their own debts, faced an impossible dilemma. The higher interest rates climbed, the more they had to pay just to service what they owed. Deficits ballooned not from new spending, but from the cost of the old. Nations that once borrowed freely at near-zero rates suddenly found themselves squeezed by reality. The illusion of fiscal control evaporated. In the United States, interest payments on the national debt began to rival defense spending. In Europe, the cracks between northern prudence and southern dependency widened again. In emerging markets, capital fled back to the safety of the dollar, leaving currencies to collapse and inflation to rage. The post-2008 order, built on globalization, low rates, and cheap credit, was unraveling. And yet, despite the turmoil, there was no clear path back. The tools that once saved the system had lost their power. Printing more money would only fuel inflation. Raising rates would deepen the slowdown. Policymakers were no longer managing the economy. They were managing a slow-motion implosion. Meanwhile, investors searched desperately for a new narrative to believe in. Artificial intelligence, green energy, and digital transformation became the new buzzwords, offering the illusion of a fresh boom that could somehow outgrow the burden of debt. But beneath the optimism, the same forces were at work. Speculation funded by leverage, valuations detached from reality, and a global financial structure still dependent on liquidity that no longer existed. The difference now was psychological. The invincibility of markets had been replaced by anxiety. Every rally felt fragile, every rebound temporary. The faith that central banks could engineer endless prosperity had been replaced by a quieter, darker realization that they had simply borrowed it from the future. The bill was coming due, and the future had arrived. By late 2024, the cracks in the global order began to show not just economically, but geopolitically. Rising interest rates strained the fragile balance between nations. Trade slowed, currencies fluctuated wildly, and the dollar's dominance, once unquestioned, became a point of contention. Countries that had relied on cheap global capital began seeking self-sufficiency. The globalized world of cheap goods and easy credit began to splinter into regional blocks. The same system that QE had globalized was now fragmenting under the weight of its own contradictions. The promise of infinite liquidity had created not unity, but dependency. And when the liquidity drained, those dependencies turned to rivalries. The economic map of the world was being redrawn, not by design, but by desperation. Amid it all, central banks faced their most existential question. What is their role when money itself loses meaning? After 15 years of manipulating every market, they had become prisoners of their own influence. Every decision carried global consequences. Every hesitation moved trillions. The illusion of control had become the burden of omnipotence. The trap was perfect. They had succeeded too well. By protecting the system from every failure, they had made it incapable of surviving on its own. Cheap money had not just distorted the economy. It had reshaped the human relationship with risk, value, and time. The world no longer saved for the future, it borrowed from it. Investors no longer priced reality, they priced faith. And as the age of cheap money ended, the reckoning wasn't just financial, it was philosophical. As the age of cheap money faded, its echoes lingered not just in markets or balance sheets, but in the collective psychology of societies that had come to mistake speculation for progress. For 15 years, people had lived inside an artificial gravity, one where wealth seemed to materialize from clicks and charts rather than labor and invention. When the spell broke, it wasn't only portfolios that crashed, it was meaning itself. The generation that had grown up believing that every dip would be bought, that risk was an illusion, and that liquidity was endless suddenly confronted a world that demanded patience, discipline, and loss. The end of cheap money marked more than a financial correction. It was the cultural end of an era built on dopamine and leverage. During the years of zero rates, entire industries had evolved to monetize attention, not productivity. Venture capital flooded into startups chasing scale, not substance, because the cost of failure was near zero. Influencers replaced entrepreneurs, and valuations replaced value. When credit tightened and the easy funding evaporated, the digital mirage dissolved. The world was left with an excess of brands and a deficit of builders, a surplus of narratives and a shortage of reality. The cheap money generation had also inherited a warped sense of time. In an economy where future profits could be discounted to infinity, the future itself lost importance. People stopped saving because saving was punished. They stopped waiting because waiting was irrational. Every incentive favored immediacy. Buy now, borrow now, consume now, because tomorrow would always bring more liquidity, more stimulus, more rescue. When interest rates rose, that future snapped back into focus like a long-ignored debt collector. Mortgages doubled, credit cards soared, and suddenly the math of ordinary life mattered again. The very idea of limits, long erased by policy, returned with vengeance. Inflation, once a statistic, became a daily teacher. It reminded people that money is not wealth, that purchasing power is not permanent, that the state cannot print abundance. For a generation raised on the promise of infinite growth, it was a profound psychological shock, the rediscovery that scarcity still rules the real world. Culturally, the cheap money era had inflated more than markets. It had inflated egos, expectations, and entitlement. The illusion of easy wealth bred a silent arrogance, the belief that prosperity was a birthright, not a fragile equilibrium. Entire societies reoriented around asset appreciation rather than innovation. Homeowners watched property values rise and mistook luck for genius. Tech founders mistook capital for creativity. Governments mistook market calm for consent. When the tide went out, what was revealed was not just financial fragility, but moral complacency. The architecture of modern ambition, from influencer culture to corporate strategy, had been built on borrowed confidence. Without the constant reinforcement of rising prices, that architecture cracked. Creativity had to relearn humility. Politics had to relearn honesty. Economies had to relearn work. Politically, the end of cheap money shattered the illusion of painless governance. For decades, leaders had purchased stability with liquidity, promising growth without sacrifice and protection without cost. Low interest rates made every promise affordable. Once those rates rose, reality intruded. Welfare systems strained, infrastructure decayed, and voters realized that the fiscal miracles of the past decade had been financed with tomorrow's taxes. Disillusionment spread. Populism, already simmering, found new fuel in the anger of those who discovered that their prosperity had been rented, not earned. The great redistribution of the cheap money years, upward, toward those who owned assets, reversed only in resentment, not reform. Citizens demanded accountability from institutions that no longer had credibility. Trust, once the invisible currency of democracy, proved harder to print than money. The spiritual cost was quieter but deeper. Easy money had promised freedom from want, from work, from worry, yet it produced a different kind of bondage. People no longer measured success by contribution, but by valuation. Net worth replaced self-worth. When markets fell, so did morale. The crash was not just economic, but existential. It revealed how thoroughly the language of finance had colonized the human imagination. Words like growth, momentum, and yield had become metaphors for life itself. When they lost meaning in markets, they lost meaning everywhere. The reckoning that followed forced a collective introspection. What does it mean to build when building no longer guarantees profit? What does it mean to save when money itself decays? What does it mean to plan for a future that no longer compounds? In the silence after the stimulus, those questions echoed across societies like the aftershock of an earthquake. And yet, within that silence, a different tone began to emerge, quieter, humbler, but more grounded. The death of cheap money forced a revaluation not just of assets, but of values. Families relearned thrift. Communities rediscovered local resilience. Entrepreneurs turned from speculation to sustainability. Economies, stripped of their artificial accelerant, began the slow, painful work of rediscovering productivity. It was not romantic. Recessions never are. But it was real. After decades of illusion, reality, even harsh reality, felt strangely liberating. The world began to remember that creation, not credit, is the true engine of wealth. That progress requires constraint. That abundance without cost is as destructive as scarcity without hope. The cultural recalibration was incomplete, messy, and far from uniform. Some clung to the old faith, waiting for the next central bank pivot, the next rescue rally. But others saw that the era of constant rescue had ended because the rescuers themselves needed saving. The global economy stood at a crossroads, not of ideology, but of identity. It had to decide whether to rebuild on the hard ground of reality or to chase another mirage of engineered prosperity. Cheap money had taught humanity to mistake liquidity for life. Its death offered a final, painful lesson: that value cannot be printed and meaning cannot be leveraged. As the shock of withdrawal faded and the world adjusted to the weight of real prices and real limits, the long arc of the cheap money era came into clearer focus. Historians would one day write that the first quarter of the 21st century was defined not by technology or politics, but by liquidity. The belief that the cost of money could be suspended indefinitely, and that credit, properly managed, could replace creation itself. When the illusion broke, what remained was a civilization forced to rediscover discipline after a long intoxication. The next system began, not with a revolution, but with fatigue. People, markets, and nations were simply tired of volatility disguised as progress, of wealth measured in paper gains, of policies that promised stability yet delivered dependence. Out of that exhaustion, new priorities emerged: sustainability over speed, productivity over price, work over wealth. Central banks, stripped of their mythic authority, retreated to a humbler role. No longer architects of perpetual growth, they became caretakers of credibility, relearning the ancient truth that money's value lies not in its abundance, but in its scarcity. The private sector followed suit, albeit grudgingly. Investors who once worshipped at the altar of leverage began to prize solvency. Companies that had lived on cheap refinancing turned inward, chasing efficiency rather than expansion. The age of growth at any cost quietly gave way to an age of return on reality. Innovation did not die, but it matured. The easy bets of zero-rate speculation were replaced by the harder art of invention that must justify itself without subsidy. Startups once built to flip became companies built to last. The market, cleansed by loss, remembered how to discriminate between promise and performance. It was a painful cleansing, but it restored an old rhythm: success earned, not engineered. Politically, the world faced the reckoning of its debts: fiscal, moral, and environmental. Nations that had borrowed to postpone choices now had to make them. Some turned inward, embracing austerity and national resilience. Others sought regional compacts to share the burden. The dream of infinite globalization softened into a patchwork of pragmatic alliances, bound less by ideology than by necessity. Power shifted subtly from those who could print to those who could produce. Resource-rich nations regained influence. Manufacturing returned to places that valued reliability over cheapness. Inflation, though tamed, left behind a scar, a collective memory of how fragile abundance can be when detached from reality. Citizens demanded accountability not in speeches, but in spreadsheets. They wanted to know what their governments could actually afford, and they demanded that policies be costed not in promises, but in interest rates. Culturally, the recalibration deepened. The mythology of the billionaire genius and the meme trader lost its charm. Admiration drifted toward builders, teachers, craftsmen, those whose work yielded tangible results. Universities began to teach financial history again, not just finance. Students studied not how to exploit cycles, but how to survive them. The language of success changed. Valuation gave way to value, momentum to meaning. Even the arts reflected the mood. After decades of hyper-consumerist optimism, a quieter realism emerged: stories about endurance, repair, and humility. Humanity, having flirted with omnipotence through monetary manipulation, rediscovered that limits are not prisons but frameworks within which meaning can exist. Technologically, the legacy of cheap money remained paradoxical. The same liquidity that inflated bubbles had also accelerated breakthroughs in renewable energy, AI, biotechnology. Those technologies did not vanish with the money. They matured in the harsher climate that followed. Artificial intelligence, once hyped as a magic lever for infinite profit, evolved into a disciplined tool for efficiency and insight. Energy transitions, once funded by speculation, found footing in necessity as the real costs of scarcity became clear. The discipline that followed the crash became the forge in which sustainable progress was tempered. It turned out that innovation needed limits as heat needs friction. Without resistance, nothing strengthens. For central banks, the final lesson was both humbling and clarifying. They learned that markets are not machines to be optimized, but ecosystems to be tended. Every intervention carries side effects. Every rescue breeds dependency. The task ahead was no longer to abolish cycles, but to shorten excess and soften collapse. Policy returned to modesty. Interest rates found a new equilibrium, higher than before, but grounded in reality. Balance sheets shrank slowly, deliberately. The phrase quantitative easing faded into history, a cautionary relic like gold standard or Bretton Woods. Future generations would study it as a grand experiment in human ambition, proof that even in an age of algorithms and data, psychology still rules economics. And in the quieter households of the post-QE world, personal behavior shifted in tandem. Saving regained dignity. Debt regained stigma. People began to measure security not in market gains, but in independence from them. The rediscovery of restraint became the foundation of a new kind of optimism, one not built on the fantasy of perpetual expansion, but on the confidence that balance could be sustained. The cheap money era had promised that everyone could be rich. Its aftermath taught that not everyone needs to be, if value is honest and life is livable. The pendulum that had swung so far toward abstraction began to return towards substance. Looking back, the 15 years of QE appeared not merely as an economic cycle, but as a parable, a demonstration of how modern civilization, armed with infinite data and finite wisdom, mistook liquidity for progress. Yet within the wreckage lay a strange grace. By overreaching, the system had revealed its own boundaries. Humanity had looked into the mirror of money and seen its reflection, impatient, ingenious, afraid, and in that recognition lay the possibility of maturity. The death of cheap money was not the end of prosperity, but its purification. It stripped the world of illusion so that growth, when it returned, could be real. The next age, historians might write, was born not in a crash or a crisis, but in the collective sigh of a civilization that finally remembered what wealth really means: the capacity to create, to endure, and to value what cannot be printed.